I like the idea. Someone just messaged, I should give the rubber chicken a name. Maybe I have. And how do you know he's a rubber chicken? Anyway, uh, things do bounce around a lot like cycles and industries and rubber chickens. Um, I wanted to mention real quick a discussion I've been having with some marketing people today about their particular view of the internet from the 90s as a reflection or as a sort of precedent for what they perceive to be how a lot of media, especially, are reporting on their work as basically being akin to the markets of the 90s when we saw the dot-com bubble come to rise and you saw tons of different companies come out of nowhere, suddenly going from an idea to something worth millions or hundreds of millions or even billions of dollars on paper. But it was all for naught, obviously, if those companies didn't have anything profitable and they eventually crashed with the dot-com bubble crash, right, when it burst. So really, that period of time, if you think about it, step back or go up a level and look down at the surrounding landscape, and you'll notice that the difference is quite stark. For one thing, in the 90s, a lot of these companies that were coming up in Internet 1.0, commercial Internet 1.0, if you will, they were a lot of the times funded by venture capital or other kinds of seed funding that came from private institutional investors, or maybe they had larger capital rounds already from the market, or those that had gone IPO, right? Which is an initial public offering, very different from what you see in cryptocurrencies, which is still unregulated largely. And ICOs and token sales and airdrops and all those kind of things are nothing like like IPOs, right? Completely different, entirely different standards, entirely different benchmarks, entirely different rules, entirely different oversight and audits, and you name it, it's just different. Just the acronyms sound a little similar. Apart from that, they're basically different. And one of the major differences is that in order to be involved in an IPO, apart from if you're the company, on the market side, traders and investors and investment banks and all of those sort of institutional financial sources, they're all very well financed, first of all, and very well regulated. In the crypto market, anyone can be a crypto investor, right? And just buying crypto and holding it or distributing it or doing whatever you do with it. Investing crypto doesn't require a license. And so anyone can be a crypto investor or a blockchain investor just by saying they are and buying a few dollars worth of something. Normally not in that order. But it doesn't require much or practically anything. If you just get a bunch of tokens for free from some various airdrops, you could call yourself a crypto investor, which is ludicrous, but that is what it is. Is it really ludicrous? I don't know, but it is definitely a new paradigm in terms of how people think about currency or digital money or digital cash or whatever you want to appropriately call this new form of a medium for transferring the value of something between two parties, right? So in that sense, there's a very, very big difference, right? In the 90s, that bubble was formed largely by the fact that it really was a very revolutionary technology that was shaping new access to information. And it was literally a period when information became incredibly and exponentially more democratized than it had ever been in human history. The financial side, the financial internet hadn't yet been created. You could send money back and forth, but you were sending fiat through some systems like PayPal or whatever, before that. But the investment came from large institutional houses. And now, why is that different? Well, those are the exact same kind of institutional systems that were in place for 100 years and have been in place since the 90s as well. And they make or break markets very often by manipulation and by intent, and short of calling it collusion or conspiracy or anything like that, it's just the market. It's the invisible hand of the market. Sometimes it's not quite so invisible, but it has a huge impact on companies and markets that try to go public or do other things. And we're seeing now in crypto the comparison of crypto to the .com bubble. Well, we're seeing that already since a year or two, even more, but especially in the last couple of years when we saw tremendous rises in Q4, towards record highs last year and also the year before that. And what you have to keep in mind is that until last year, really until after it crashed from the $20,000 all-time highs in the Bitcoin space and overall in the crypto market space after the January 2018 crash, we didn't really see many institutional investors and big VCs or big, funds or hedge funds or anything like that in crypto. And there were a few here and there, but it was not a predominant thing you would read about in the news on a weekly or even daily basis. Now, in the past year, increasingly, we've seen that since the crash. More and more institutional money is getting into crypto. More and more institutional money is backing blockchain. At the same time, these large institutions are, on the one hand, talking down crypto because they love keeping the prices cheap while they buy up as much of it as they can and prepare their products and services to sell to the masses. At the same time, right, they're doing that. So they're buying it cheap and preparing to sell it high to the very same people that they're warning about don't get involved in crypto. It's a risky thing and this and that. And yet they're taking up as much position as they can in it because they know it's the future of currency with a very high degree of probability. It is the future of currency. To deny that is to deny the significance of email in 1994. And I can tell you back then, it was very evident to anyone using email, it was a world game changer. Right? Instead of sending messages that took days or even weeks or sometimes longer across the world, you could now in seconds send via commercial email, or even non-commercial email. You could send a message to somebody around the world in a matter of seconds, right? That changed everything. And blockchain is doing the same thing. You may not understand it, you may not appreciate it, you may understand it fully, and you may have your own politics as to which version of whatever is better. That's fine. But remember, killer apps that change the world for the internet include email, the web, FTP, which you may not even be aware of, but it really did democratize the ability for information to flow back and forth. Social media. There's no shortage of the specific texts that were used. And if you look at the ones that had the most impact, Linux, right, had a massive impact on empowering servers to empower the web. And it's open source, right? Same thing with the World Wide Web, HTML, it's open source. Email itself is, a technology that is essentially open source, although all the different variations of how to access it are, for the most part, not. But there are some email, programs that are still to this day open source. So the ones that had the most drastic impact are probably not the ones that you think of in a very small parochial way. Maybe they'll do great for certain investors, maybe they won't, but the ones that I look to on a mass scale for adoption, something that will be open source or something that can at least spread as well as open source, It will probably have to be open source and royalty free to, no money to the developer of it. It's probably something that we don't even have yet or can even think of yet. Maybe, or maybe it's something like Bitcoin, which effectively is open source, and is decentralized. It's not owned by any one party. It's not governed by any one party. And those kind of things can lead to massive revolutions. But in terms of the bubble that they develop, that dot-com bubble again was funded by big banks. The crypto bubble we saw last year was not. It was funded by folks like you and me, just average street investors putting our money in, buying cryptocurrencies we thought would rise, and the smart ones sold, and the ones who weren't so smart at selling didn't sell on time and maybe lost some money, maybe lost a lot of it. But the ones who are still holding on might be in for a big surprise when the next wave comes around, because the next wave could crush crypto if done wrong, but it could also take it to significantly new heights, right? For example, if the next wave comes in and all there is just fear, but they buy in for the FOMO, right? They don't want to miss out. So they're buying, then we're going to see a huge spike and then boom, crash again, right? And that's if just retail buyers go in and out. Then it happens a lot in Q4. So you might see that around November, December. You might see a spike in December. It might last a little bit until January, and then spike down or crash down fairly quickly. That happens almost routinely in crypto at this point. Maybe it won't happen this year for a variety of reasons, but it could. And then the other factor is if all the institutional investors now come in before the actual tech is evolved to a higher state, and if the institutional investors start pushing sales in order to drive up revenues from crypto right now or in the coming weeks, you could see a bubble start to grow, and they could, in theory, push that bubble for some months or even a year or two. Who knows? Things like that have happened, although a 1 or 2 year, straight up is pretty unusual and usually not the best sign of a healthy market, especially if the technology hasn't evolved yet to the point where it has to be. And so once again, if there is going to be a crash in crypto, I think that it's actually going to be bigger and worse once the institutional investors are in the market. Because until now, the crash that happened last year, as bad as it was, didn't destroy the market, didn't even come close to destroying the market. And the lows are still at record highs before last year's bull run, right? So the market now sits at essentially another new threshold of height, sustained by the retail investors, and now more and more by institutional investors who are sneakily or quietly buying their way in. Some are more, vocal and open about it, but many of them are doing it under the radar or behind your back, or however you want to say it, in the dark. They're not, showing off their massive purchases on exchanges. They're doing a lot of OTC buying. So basically with over-the-counter buying, those records are not listed on the exchanges. And what that means is they're pumping a lot of money into this market to get goods on the cheap. And then when they're ready, they'll spike it, right? And the question is the retail investor going to fall for that? Or is the retail investor going to look for actual real value this time? Because until now, the past 10 years, the retail investor has built and sustained this market through the ups and the downs and the other ups and the other downs. It's all been on retail investors, private individual citizens. And that's also one of the things that has made crypto and blockchain grow organically in the way that it has to this point. And if you take that away, if you hand it over to these institutional investors who want to do ETFs and all these other, glory trophy kind of things, you change the nature of crypto in some ways, for good and for bad. On the one hand, you're going to have much more sort of predictable growth trends and sales trends and all those kind of things, which is maybe good for the market and stability. On the other hand, it's going to do the very thing that crypto has tried to get away from, right? That's the purpose of why crypto was created. Cryptocurrency was created in order to decentralize money and take it out of the hands of fiat governments and to put it into the hands of the individual owners of the money. That's you, right? And me and everybody that owns the money. And if suddenly the institutional investors come in who are regulated by government, they took over everything and they are essentially owned by Uncle Sam or their respective countries, then you're talking about a shift yet again within the paradigm shift of cryptocurrency, where the money goes from for the people, of the people, by the people kind of thing, a democratic form of money in a sense, or a libertarian form of money even, back into a government-controlled form of money, when the entire point is to be not government-controlled. So what would happen then to all the cryptos that people love and hold dearly when they realize that these cryptos are no longer not in government control? And you could argue that many, or maybe even all, already are, because of backdoors and who knows what, a lot of different theories about what exactly is owned by the governments, which governments own what, in terms of Bitcoin and other leading coins. That would cause a tremendous shift, I think, and that could lead to a much, much bigger bubble and then crash of crypto if the technology does not evolve and if institutional investors and governments are allowed to effectively take control of the market before the technology is significantly involved to actually be massively adopted in a practical sense, where people routinely use it day to day without thinking about it, and they don't have to worry about conversion fees and gas and all these other things that may make investing in crypto currently awkward. But it may make, once the platforms figure out how to make it easier for everyone to use it day to day, then I think you'll see a lot better, adoption of it. But again, if governments control crypto by then we really haven't changed anything, right? If the ideology is to mean anything to the people who have fostered cryptocurrency for so long. And what it would really mean is that the true face of why a lot of cryptocurrency holders have been in it for so long has nothing to do with values or ideologies or principles, but it just comes down to the same thing that everybody is always chasing, with, the desire to have more. Call it greed or whatever you want to call it. It's fine. Nothing wrong with it. It's a perfectly healthy part of being a human. But it would mean that essentially the principled values of cryptocurrency are not as solid with the technology at hand. Right? It would need to evolve into yet another form of cryptocurrency or blockchain or something else if you wanted to actually remain out of the regulation and all that stuff. And that's another thing. People always say in this market, you hear a lot of discussion about regulators. Where are the regulators? Why? It's too risky. You're not going to see growth in crypto again until you have regulations in place. For 10 years, people have been investing in crypto. For 10 years, there has been no regulation in place. Where was the regulation last year during the bull run? It didn't exist. Where was the regulation the year before that, when it was just growing steadily? It didn't exist. Where was the regulation after the crash of 2013? It didn't exist, right? Where was the regulation after the growth of 2012? There were no laws and regulations in place governing crypto at that time. And yet, in those years, you saw bull runs. You saw tremendous growth. And a lot of people made a ton of money. Some got out very nice and happy. Some stayed in and got even crazier and wealthier. So keep in mind, A lot of regulation, a lot of stability does not always mean that it's in the best interest of the investors who are individuals, and it certainly doesn't mean it's in the best interest of the market itself. Sometimes it can be useful to have a modicum of regulation to keep some sanity and to prevent people from doing, terrible things like trying to control markets in a conspiratorial way or an antitrust kind of way. But cryptocurrency is a different animal. It is about the individual's ability to own their money safely and securely without having to rely on third parties. You don't need a bank. You don't need a credit union. You don't need a escrow service, and that's third party that has nothing to do with you. Unless you choose to use it, you shouldn't have to be tied to it, right? There are plenty of great escrow services that are coming up in crypto, and those are things that people will choose to use if they want to. So that way, mutual parties can do deals with escrow service, contracts, with definitions and sort of actionable things related to the escrow service. That's great, but they don't need to use a sort of legacy escrow service that has much higher fees and all these other regulations on top of it that neither party needs or wants. So can all of this, which I've just been rambling about now for a long time, can all of this mean that we'll see an even bigger bubble with crypto than we saw in the dot-com bubble? Yeah, absolutely. If you look at the charts, technically it's already kind of bigger. It's lasted longer in a sense, but it could definitely be bigger, exponentially bigger than the dot-com bubble ever was. In many respects, it is again. But in terms of percentage of growth on the market, I'm talking about, yes, it could be much, much bigger. Of course, the danger with that is that, again, like I said, if the tech isn't there and the institutional investors are all clawed into the system of crypto, then when that bubble crashes, it would probably be more devastating than any bubble crash we've seen, at least in the last 40 years, probably more. So, on that cheery note, I just want to remind you that blockchain and crypto is actually growing like crazy, despite the low trading volume and this and that. The software developers are hard at work, and we're seeing tons of amazing projects. And I think it's really a great time to be getting into crypto and blockchain. Even if you don't invest in it or buy in it, that's fine. Just to read about it, understand what it is, get your mind wrapped around this concept that people are trading goods and services using digital cash, and the ability to overlay that with smart contracts and everything else is going to make the life of marketers and the life of business people and the life of just anyone in general, consumer, down to the consumer, very different than it is now. 5 to 10 years from now, expect it to be very different than what we see it now. Just like email was very different before Gmail, just like social media was very different before Facebook, just like photo sharing was very different before Instagram, and text chat was very different before WhatsApp. Trading goods and services was very different before blockchain, and now it's a whole new world. So get into it. I highly recommend it, especially if you're into marketing. And again, subscribe to this channel if you haven't already. Do something to engage with whatever we're doing. I think the button's here, right, if you look at the video. Until next time, folks, take care.